Hello everyone, and welcome back to another episode of HyperNest Podcast. During this episode, we are going to discuss about StableJack that is innovating with their incredible product in between, let's say, Pendle and in between also GMX, but providing actually a very novel innovation, a new primitive. So it's something that is never been done before, and we have the incredible pleasure today to discuss with Cesar, that is a co-founder of StableJack, and today is going to help us to understand more about the mechanism design, the new feature of StableJack V2 that are super exciting. So, well, before going further down this fantastic rabbit hole, I would like to ask Cesar to introduce himself, and then we move forward to discuss about StableJack.
Yeah, hello. First of all, thank you so much for the invitation. As you said, it's a Caesar. I am one of the co-founders of StableJack. About myself, I have been in the ecosystem since 2017, and for the first couple of years, I was just doing trading, etc., basic DeFi primitives. But after a couple of years, I started to work in DeFi protocols, specifically structured products, which actually allowed me to conceptualize StableJack during those times. And for the last 1.5 years, we have been building StableJack with my two other co-founders. And I think this can be a brief intro about myself.
That's great, and I'm happy actually to meet you again. So the first time I think was in Turkey, if I remember correctly.
Yeah, during Ethereum event.
Amazing. All right, so there might be some comparison, with StableJack, but in reality, StableJack is actually very new. That's why we are so excited to talk about it. Do you want to tell us a little bit more? How did you get with your co-founders to the conceptualization of StableJack?
Yeah, actually, the first idea came after the USDC DPEG, because people were, and also Luna, and people were interested in stable coins and also earning yield. So we were working on how to make such a product, even though it sounds easy right now. Couple of years before, 2 to 3 years, it was not, how can I say, something easy to think of, yield bearing stable coins, yield product, etc. So this was the spark for us to build a product. And what is StableJack? We are building a yield, volatility, and points marked for any asset. How does it work? Or basically, what is the value proposition? We offer fixed yield and leverage yield on top of stable coins and blue chip assets. We offer leverage airdrop farming, and also we offer leverage exposure to collateral without liquidation risk. So this is the basic value proposition of StableJack. Currently, we are live on Avalanche and Sonic. Within a couple of months, we reach 13 million in TVL with 80% retention rate, and we are currently working. We launched our version 2 a couple of months ago, and currently working on some optimization and bug fixes. And after completing them, we are going to roll out new assets so that people have more options.
Okay, that's super exciting, and thanks a lot for starting already a little bit of the description of the main feature of StableJack. Maybe we can go a little bit deeper in that. So, as far as I know, StableJack have 3 tokens. So essentially, you can use 3 tokens using StableJack. One is the YT token, which is not another YT, is the YT of StableJack. That is the yield token, right? Then we have the VT token, that is the volatility token, right? And the third one should be the PT or PT token, points token, sorry. So do you want to basically tell us a little bit more about these 3 tokens and maybe also what is the main usage from different personas?
Yeah, actually, this is a bit confusing for newcomers because most people know PT and YT from Pendle, and understandably when they see StableJack's YT and PT they are get confused. So basically, let me explain them separately. What is YT on StableJack? Basically, it is yield token, and it receives the entire yield of the collateral with principal protection. Thus, we can offer leverage yield exposure on top of a specific asset. And what is points token, PT? It is basically a token that receives the entire points of the collateral asset with again principal protection. Thus, we offer leverage points exposure. Lastly, what is VT? It is volatility token, and it receives the entire price action of the collateral asset. So we can offer leverage exposure to collateral without liquidation risk or paying any funding fee. Maybe I can share more details about how it works. So, like on StableJack, there are three options: yield versus volatility, yield versus points, and only yield trade. Let me explain them separately. In the case of yield versus volatility trading, like we have a collateral asset like an LST, and it has a yield associated with it and also a price action like derived from the collateral itself. So StableJack strips the yield and volatility into two separate assets, and one asset receives the entire staking yield of the collateral asset. So it has leverage yield exposure, but it is not exposed to the price action of collateral asset, because to earn leverage yield they are giving up on the price action. So they are earning leverage yield on top of their asset. On the other hand, we have volatility token. Users are giving up on their staking yield so that they have leverage price action exposure to the collateral asset. Thanks to that, they have again leverage exposure to collateral without liquidation risk or paying any funding fee. This is our first product, yield versus volatility pair. The second pair is yield versus points pair. And again, in very simple terms, an asset has yield and points. Like in the case of, like, let's say on Sonic, we have several pairs of it. And what we do is that we strip the yield and points of the asset into two separate assets. If you mint yield token, you are giving up on your points for leverage yield. If you mint points token, you give up on your yield for leverage points exposure. While doing that, you are maintaining your principal exposure. There is no maturity date. So you can be assured that even though the points are not performed as expected, you will still maintain your principal exposure. Lastly, we have yield trade. This basically actually similar to Pendle. You short or long the yield for the, like, based on its future projection, and like basically you can have fixed yield for a certain period of time with again no maturity date, or you can long the yield and have leverage yield exposure. So in the end, if the yield is performing as expected or it performs better, you will earn more. Or if it performs worse than expected, you will you will earn less than if you will just hold the underlying asset. So this is the logic actually. Oh, I hope that makes sense. I know it is a bit confusing for the newcomers, but I hope that makes sense.
It does for me. Let's unpack it. Let's unpack it one by one. And I'm sure that if we unpack it a little bit and also we connect, let's say, one specific vehicle or instrument with a scenario, that is going to be ultra clear. So first of all, we might have people that really love to have YT, right? So these people that love YT are probably traders that are probably a little bit more conservative, right? Because if I have, let's say, $100 of WSTAT or another, or SAVAX, right? I can deposit. Tell me if I'm right, Cesar. So I can deposit these $100 of AVAX, and I will get a stable coin called AUSD, and this stable coin AUSD will remain $100. So as a stable coin, so I have $100 today, I will have $100 tomorrow. Ideally, I will have $100 forever. And at the same time, I'm not giving up on the yield. Therefore, I'm still getting the majority of the yield coming from SAVAX or coming from WSTET, right? So essentially, I am a conservative trader. I don't want to be exposed to price volatility, right? But I want to have the yield, because at any point in time I can go back and I can basically exchange one more time this $100 that I have in $100 of AVAX. Am I on the right track, at least for the first instrument, or close enough?
Yes, that's right. Like basically, if you are unsure about the price action of the collateral asset, in the case of AUSD, it is AVAX, you can just deposit your assets into the protocol and earn yield. Like for the first 6 months of the protocol, we have generated more than 20% yield, and the remaining period has been around 15%. Since the market has been like tanking, like the yields are also decreasing, but we were able to offer the most competitive and consistent yield just because we are exchanging the yield and volatility of the collateral.
Yeah, great. And then for the second instrument, let's say the VT token, I think my assumption is that your main personas is more like a leverage trader that want to have a leverage exposure to an asset. Is that correct?
Yeah, that's right. Like as you know, like there are several traders who want to have long-term exposure, but who also do not want to pay funding fees, or like they are unsure about liquidation risk, etc. So actually, XAVA this specific problem. If you want to have leverage long exposure for a long time, like you don't have any option, because in a perpetual exchange, if you have your position like open for a long time, like you will pay a hefty funding fee. So StableJack solves this problem. So it is specifically catered for such group of users.
And am I right in thinking that I also am not going to have liquidation if I'm holding VT token?
Yeah, that's right. Like this is the main value proposition. Since like the protocol is always collateralized, and actually like there is no leverage contract, like you can't be liquidated. Like this is technically impossible.
That's fantastic. Fantastic. So, and what is usually your average, let's say, leverage? So it is maximum 2, between 1.2 plus 2. I don't know. I was reading, but I don't know.
Like actually the leverage can be up to 4x, but it is variable. Like the market determines the leverage based on the demand for XAVAX and AUSD. As far as we see until now, it has been mostly around 1.5x. So this means that like basically leverage side is around, again, for more people who are not like preferring 10x leverage, 5x leverage, or 20x leverage, but lower side of it. So like this is what we have seen until now.
Okay, that's very helpful. And the last one, the last instrument that you have is the PT, so the point token. So in this case, I assume that here we are serving more airdrop farming and this type of category. Is that correct?
Yeah, that's right. Most of the time, like people would love to increase their exposure to points, if especially if they are small size participants, because like let's say if you have $1,000 and if you just earn 5% yield on top of it, this means it is just $50, and like it is not changing life. So they are trying to increase their return by increasing their exposure to points token. So this is specifically for those type of people who wants to like earn more with their smaller amount of assets.
In this specific case, the user journey will be: I arrive into StableJack, I deposit my collateral, and I mint against it the PT token, but I'm not losing my principal. Is that correct?
Yeah, that's right. It is principal protected, like compared to Pendle. So this is a different use case.
Exactly, because you can basically have your principal back, which is kind of a big deal, I guess.
Yeah.
Okay, that's amazing. I think we've been going one by one, and now maybe we can dive a little bit deeper in the mechanism design of StableJack.
Sure.
So, a little, thinking about the first type of scenario that you were illustrating. So essentially, we are discussing about yield versus volatility, right? So how does it work under the hood? So I have been studying a little bit your formula, but maybe you can unpack a little bit this information to explain a little bit better us how the system is designed.
Let me give a specific example. Like for example, we are utilizing SAVAX as collateral. So SAVAX includes two things: AVAX price action plus staking rewards. So if you hold SAVAX, you will be always exposed to AVAX price action, plus you will earn around 5.25% staking rewards. Like what we do is that we accept that asset as collateral and strip its yield, the staking yield, and price action into two separate tokens. So like we are dividing the collateral and wrapping up two new tokens. One of them is AUSD, and it only receives the yield generated from the collateral. So like let's say you have 5 SAVAX and I have 5 SAVAX, and we are depositing them into StableJack, and in return you are getting AUSD and I am getting XAVAX, but I am receiving 10 AVAX worth of price action and you are receiving 10 AVAX worth of staking APR. So even though you just have 5 AVAX allocation, you are receiving the double the amount of staking rewards that you will get, and I am getting double of my existing allocation in terms of like price action. So this is the way the product works in a simple but in a more detailed way. But if you have any specific thing to ask, happy to answer.
I do. So I think, I mean, I've been studying a little bit how you can influence the demand of these two assets. So, but what for the system? First of all, let's start from this question. For your system, what is the optimal scenario? So in the optimal scenario, you want to have YT and VT in balance.
Like we always like want to have more YT compared to yield token, because this means that there will be more like the collateralization ratio will increase, and also the yield for the yield token will be higher, which will make the product more competitive. But if there is more demand for the leverage side, meaning volatility token, this means the leverage will be decreasing. So it will be less appealing for those people who wants to have leverage. And in that scenario, we will need more demand for the yield token, which will increase the leverage for the volatility token holders. So in the end, in a simple way, having an equilibrium is great, but maybe more demand for the volatility token will be better for us, because this increases the yield for the yield token holders. In return, more demand for the yield token. This means higher leverage for the volatility token holders.
I see. And have you ever experienced in the history of StableJack a situation of strong imbalance between the demand of either one, and how did you react to that?
Like until now, we haven't faced a major problem in terms of the balance of those two assets. But we have seen more demand for XAVAX, the volatility token, compared to the yield token. So this is something good. And like what we have realized is that like during the bad market conditions, people are increasing their exposure to volatility token. And actually this is a very rational act, which we haven't expected, because like basically we assume that
Yeah.
when the prices are up, people buy, and when the price is down, people sell, so they lose. But this has never happened in our case. When the market is up, like people are decreasing their exposure, and when the market is down, like people are increasing their exposure. So we have several smart traders, which actually people can just try to
Yeah.
copy. So this is something interesting, but like until now we are pretty fine with it.
Okay, so essentially, what you're saying that in the last period, probably, and in particular in the last few days with the tariffs turmoil, we
Yeah.
there were a lot of people entering and buying, for example, ex
Yeah,
AVAX to long
yeah,
AVAX because they were expecting a rebound, which
yeah,
happened, by the
that's
way.
right. That's right.
All right, well, that's great, I would say. Okay, so this is clear, but in case there was a strong imbalance in the situation, you can still basically pull some lever. So potentially you can increase the minting fee of one asset, right?
Yes, actually, we have several mechanisms based
Yeah,
on different tiers of collateralization ratio. The smart contracts take action, and like let's say in the case of 160% collateralization ratio, the minting fees and redeem fees are changed in a way that we are increasing demand for volatile token while decreasing the demand for the yield token. And let's say if the collateralization ratio decreases more, and we have 147% collateralization ratio, the protocol automatically deleverages itself. How? Like you know that like to earn yield, users need to stake their AUST, and
yeah,
those AUST that is staked in the rebalance pool are converted into SAVAX. But this doesn't mean that users are losing their principal. Their principal is converted from AUST to SAVAX so that the protocol delever itself. But actually, this is something good for users because if the protocol delevers itself, this means that like the collateral has decreased so much that it should possibly go up in the near future. So you are buying the dip actually. So this is something until now we haven't faced. But if we would have faced, this would possibly uh, s- prove that we are in the dips of the market. So it is good time to buy the collateral asset instead of just staying in stables. So this is the logic.
I see, I see. But in the case, let's say the collateral, in this case AVAX, correct dramatically, sharply, we might have a situation where the volatility token goes to zero. Or I mean, if all the guardrails they don't hold. Is that correct, or
Yeah,
it's an extreme scenario only?
yeah. Actually, theoretically, it is possible, but actually, like since we launched the protocol, we have seen around, I suppose, 60 to 70% decrease in AVAX price action. But even though from now on AVAX price decrease 50%, like we wouldn't face any problem. And until now, we haven't faced any such a rebalancing. Actually, this is not a problem, but a feature of the protocol, just to let you know. But even in that case, until now, we haven't seen such a problem, and we
Hmm.
won't see such a case even we decrease another 50% from this price.
I see.
Mhm.
Okay, regarding the YT token, that it's always a stable coin, right? So the YT token.
Yes, it is always a stable coin. Like we are not always calling it a stable coin because it is more like a yield product, but it is basically a USD peg asset, so we can call it a stable coin.
Okay, and and how, because we have seen a lot of stablecoin or synthetic dollar or several other categories of it, drastically depegging, as you have also mentioned at the beginning of our chat. How do you keep the stability, or do you
Mhm.
keep the stability of
Yeah,
the
actually,
white?
the protocol always assumes that the yield token specifically AUSD is pegged to $1. So even in the market, like if there is a DPEG, like let's say AUSD DPEGs to 0.98, you can just redeem it to $1 at the protocol level. So there is always a pegging mechanism. And actually, like why stable coins DPEG is that first of all, like there is no backing asset, and secondly, there is no pegging mechanism. And in case of StableJack, we have a pegging mechanism, and it is basically protocol always assumes that yield token, specifically AUSD, is pegged to $1, and secondly, the protocol always maintains the reserves and does not utilize it in somewhere else. So people can just redeem their collateral back anytime they want. And with this model, we can just honor the redemptions at a 1-to-1 ratio.
Okay, so in case of, I mean, anyway, it's probably StableJack is still based on CDP technology, right? And therefore you have, no? Yes?
We can assume like a liquid model, like similar to how the peg mechanism works.
Okay, so similar to liquidity.
Yeah,
Okay.
that's right.
I get it. And therefore, let's say if there is the peg, probably the people will just redeem their ASD versus AVAX, even if it is 0.90, whatever, they will get $1 of AVAX, and they will maybe sell this dollar of AVAX for anything else, if they want.
Sure, that's right. Like they can just do that and they can make profit on top of it.
Okay, sounds good. Well, I think one important question is how StableJack, create profit. So how do you make money?
We are generating revenue from minting and redemption fees, plus the protocol takes a certain amount of fee from the LSD yield, so it is directed to the treasury. So we are generating revenue via this model.
Okay, so minting and redemption of assets plus a percentage of the yield generated, that it's about 20% at this point or something on this line?
Yes, currently it is 20%.
Okay, very good. And I think that super interestingly, we should talk about comparison, right, between StableJack and other protocols. But StableJack, I feel like that is very unique, right? But someone is comparing it more to Pendle, someone a little bit more to GMX, but I think both of them are different. Maybe we should try to explain how StableJack is different and how it is positioned compared to these other protocols.
Yeah, actually we are positioning StableJack in the between of like Pendle and GMX. Compared to Pendle, like we do not have any maturity date and assets are principal protected, and compared to the perpetual products like GMX, there is no liquidation risk, or user are not required to pay funding fee. So this is the difference that we have between yield products like Pendle and perpetual products like GMX. So in very simple terms, like we are receiving the good size of both assets and leaving the, like, let's say, bad sides or different features of those protocols.
I like it. I think it's very, very, very cool. So let's talk a little bit more about, the comparison with the Pendle, right? So first of all, major difference where Pendle have an expiration date. Let's say the StableJack is more a perpetual, right? So there is no, if we want to have a more financial comparison, so there is no expiration. You can basically keep going with your YT token potentially, so your yield token, and there is no expiration. You don't need to roll back to the next one. Is just go. And do you want to add? Please add.
That's right. Like in StableJack, since there is no maturity date, users can just hold their assets as much as they want, and like since they are not requiring to roll over their assets, it requires less management. So it is, like, let's say, better for in a very long term space, and because like most of the time what happens on Pendle is that like until the rollover period you have to wait, and then you need to put your assets into work again. So this creates a problem where you need to pay gas fees, redemption fees, etc. But in our case, like that won't be happening. So actually, this solves the problem. Also, we haven't talked too much about it, but StableJack is depending on a pool model instead of an AMM model like Pendle. This
Yeah.
means that there is no slippage or impermanent loss on StableJack. Basically, like you put $1 worth of a collateral asset, and in return you get $1 worth of its derivative, like YT or PT or like volatility token. So there is no slippage on StableJack too. So this is another difference that we have compared to Pendle. But of course, like Pendle has been a great inspiration for StableJack, and I have been using Pendle for a very long time before the points meta. So I can say that like they are a great team, and like we have been inspired from their model a lot. So just wanted to add that too.
Absolutely, Cesar. Well, here we are all, I think, DeFi enthusiasts. So of course, we also love Pendle, as we love StableJack. So it's just for the user to understand a little bit the difference, because some less experienced DeFi practitioner might be not immediately, capable to differentiate between those. Okay. Okay, very cool. Just want to add one thing and make sure that I understood it correctly. So because there is the rollover date, in the Pendle assets, in particular the PT assets of Pendle. So you're saying that, of course, if you are doing any specific DeFi strategies, well, you will need to withdraw, you will need to redeploy, spend gas again, and so on and so forth. But because the assets in StableJack, they work a little bit more as a perpetual, then basically they have a different level of fungibility, meaning if I am doing a strategy with the yield token, well, I can keep it there without any additional, maintenance. So is this correct? Is what we were discussing just a few minutes ago, right?
Yeah, that's definitely right. Until now, we haven't integrated into the lending markets yet, but hopefully soon we will be integrating into a couple of lending markets, and this will allow more fungibility, like because you will be able to just loop the positions similar to how users are currently looping their PT tokens on Pendle. So hopefully this will also create more utility and use cases across DeFi protocols.
That sounds great. I mean, I will introduce you to a few ones that I have in mind now. Okay, and I think the other, probably the most important part is that, for example, if I am, selling my WSTAT for the YT token in Pendle, so not in StableJack, in Pendle, I am, of course, giving up on my principle to have a leveraged exposure to the yield, right?
Yeah.
But if I'm doing let's say a similar strategy in StableJack, where essentially I'm depositing my the WSTAT, or in this case when I'm minting, additional exposure, or I'm not going to give up to my principal. Is that correct?
Yeah, that's right. On StableJack, you will always maintain your principal, and on top of it, you will earn leverage yield or leverage points exposure. Basically, like let's say you like points, I like yield, you give your points, you give your yields to me, and I give my points to you. So we are just basically exchanging it. We are just leveraging the yield and points of the collateral asset. Like the principal is not touched. Like it maintains as it is, and on top of it, we are just exchanging the yield and points.
I love this way to explain it. So essentially, we are just from the same assets. We are just decomposing the assets. We are exchanging what we like the most.
Yeah,
so I give
that's
you
right.
a little bit of volatility. You give me a little bit of yield. Everyone happy, right? And then we're
Yeah,
still
that's
friends.
right. It
I
is
love
like a
that.
market on the street where some people sell points, others are selling their yield and just exchanging it.
Love it. Very, very cool. Okay, and then I think the other comparison is of course with other on-chain derivatives platform, probably GMX, DYDX. Lately also Hyperliquid.
Yeah.
So in this case, I think the main advantage of holding the VT, so volatility token in general, is no funding rate, if I remember correctly, right? No liquidation. Is there anything else?
I think these two are the main ones. Like basically, on StableJack, like you don't require to pay any funding fee or you don't have any liquidation risk. Of course, there is a trade of it. Since the leverage is variable, you can't all like for example, you won't predict what will happen in the next 3 months in terms of the leverage. So like it is a bit unpredictable in terms of your leverage exposure. But on top of that, like you won't get liquidated or paying any funding fee. So this is just a trade-off. StableJack is for users who wants to have long-term exposure and less risk, and derivative protocols like GMX, DYDX are more like for short-term traders, let's say, who wants to have quick buck or like who are doing like technical analysis and do trades. So these are the main differences, or like let's say different use cases, different user profiles that we have compared to derivative protocols.
I see, and also the leverage is lower,
Yeah.
right? So because you say that mostly on the VT historically we have 1.5x leverage, but on other protocol I can go maybe 5x or 10x, right?
Yeah, that's right.
Okay, that's very helpful and very interesting. But that's what I want to ask. But I was reading a little bit of your documentation. But are you also planning, of course, to use to allow the users to have somehow more leverage or not in the
Uh,
future?
Actually, like we want to add new assets as collateral for the volatility token, specifically Bitcoin, Ethereum, Sonic, and or maybe Solana in the future. Like basically, I think Bitcoin is also important because Bitcoin is the biggest asset and like an indicator for the whole ecosystem. So if you can just have leverage long exposure to Bitcoin without liquidation risk, this will be a great use case, and hopefully we will bring it soon. And also Ethereum again, even though the price action tells otherwise, like still people love Ethereum, the asset. So if we can make it happen as soon as possible, this will be a great addition, I guess.
For sure, and also there are a lot of ETH in the EVM world, right? So why not?
That's right.
Okay. So what about the future of StableJack? So we launched the V2. Therefore, we added, I think, with the V2 also the PT token. I think we didn't have PT token before. We are now on Sonic and Avalanche.
Yeah.
What else are you cooking, guys?
Yeah, currently, like in the very short term, we are just solving the bugs and making some optimization to the protocol. And after that, we want to make some improvements to UI so that like things get simply like simpler or ease, let's say, because since this is a new protocol, like people are having a bit difficulty to understand how it works, etc. So we are trying to make everything as simple as possible. And after that, we are planning to add new stable coin pairs on both Sonic and Avalanche. And again, we want to do yield versus volatility trade on Sonic. So basically, users will be able to long S without liquidation risk or earn leverage S yield on top of their stable coin asset. So this is short term and maybe mid term plans. And currently, what we are focusing on for the future is that we want to expand into new chains like Ethena's convergence. We are part of Ethena Accelerator program, and we achieve the second place. So we want to be on Ethereum ecosystem and have exposure to there in the near future. And also we are currently working with local banks and exchanges in Turkey. So we want to offer DeFi products to private and retail investors from centralized exchanges and banks. And also we want to utilize tokenized RWAs from those banks to offer it to the DeFi protocol, DeFi users. So these are our other plans too. Lastly, we are also working on our AI agent, which will simplify the whole DeFi process, like DeFi transaction, and making automation for the whole transactions. This is specifically catered to retail traders or Web2 users because like they are a bit having, of course, understandably having difficulty to understand whole DeFi complexity and transactions, non-custodial, etc. So this AI agent will help us to solve that problem and work specifically for retail traders and hopefully institutions in the Web2 world. So these are the plans that we have for StableJack in the let's say in the short term, like 1 to 3 months, or long term in the next couple of years.
Okay, very, very intriguing. So I like how you're also going a little bit on the institutional side. I've
Yeah,
seen pretty much everyone is going in the direction with like Aave with Horizon, Ethereum with Etherealize.
yeah, that's
So
right.
everyone is now, poaching big institution. It seems like that also you have it in your radar. Very interesting. Okay, right now, who make the decisions about what assets need to be included? For example, volatility versus yield, and are you planning to basically decentralize, for example, this model, or making it a little bit more distributed, maybe with Curator?
Uh, Actually, like currently, only StableJack team makes the decisions to which asset to list. But in the long term, we want to do it permissionless. Everyone should be able to just launch their own pairs without any decision making from our side. But also, curators are a good idea. We haven't discussed it too much. We just decided, I think, just to make it permissionless. So we will possibly go with that, but curators may be optional, similar to like maybe Fjord, like the launchpad. Like people can just do IDOs there, but if you have curators, like more reputation, so this can be also optional. But basically, we won't be in the near future. Hopefully, we won't be the only ones who make the decision to list assets, but it will be more permissionless.
Yeah, yeah, it sounds good. I was thinking about a system similar to Morpho, where
Yeah.
essentially you can have a specialized curator to manage essentially the relationship between YT and VT for new assets, because probably every assets have a different risk parameters, I believe.
Yeah, I agreed with that.
Okay, very, 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 very cool. Very, very interesting. Lately, you also launched your token, Jack. So congratulations also for the launch of your native token. And you had a little bit of different system compared with the classic airdrop. Do you want to explain a little bit
Yeah,
something
sure.
about it, and maybe also as an interesting information for the other founders that are listening to you?
Yeah, definitely. Like StableJack utilizes a new model called discount tickets. How it works is pretty simple. Similar to a liquidity mining or airdrop program, users are utilizing the protocol and engaging with the protocol, and in return, we give them discount tickets, aka points, which will allow them to buy Jack at a discount compared to its market price. And like so compared to an airdrop or liquid mining program, we are not giving tokens free. Why we are doing that? First of all, this eliminates Sibils and mercenary capital. Also, it allows power users and real users to earn outsizedly. And also, most importantly, this means that like with discount tickets, we have unlock schedule based on demand, not timing. So there is no unnecessary supply and sell pressure on top of the token. So in the long term, there is a, like, let's say, holders or stakers won't have the concern of token inflation. So this is the basic model. No supply pressure, no token inflation. Token is distributed to those who use the protocol, and since there is a requirement to pay, even though it is a discount, only people who wants to have exposure to Jack and have a long-term alignment are going to utilize their rights. So better distribution of the token itself. Also, what is the value of the token? We have a revenue sharing model in which like the protocol revenues are directed to Jack stakers. So with that, we are generating demand for the Jack token.
Okay. And what percentage of the protocol revenue are redistributed to the token holders of
At the
Jack?
beginning, it is 50%, and hopefully in the near future, like we will increase it.
Okay, but in order to redistribute this revenue, do you have like a V token model where I need to lock my token, or do I just need to stake it and then I can unstake it wherever I want? So how does it work?
Yeah, you just need to stake the token. Like there is 1 day cooldown period if you just decide to unstake. But other than that, it is pretty simple. Stake and earn.
Okay, that sounds good. The cooling down period is for how long?
Sorry?
And how long is the cooling down period? And does
One
this
day.
cooling down
It
period?
is just 1 day.
Okay, well, it's I think very, very good. It's a short time period. Okay, that's very interesting and very intriguing. Are the owner of the Jack token also involved in one way or another in the governance, or it's mostly this type of utility that we already discussed?
Like we don't have a governance utility, to be honest. Like currently the team makes the decision, and I think this is a better way because like basically the builders of the protocol should make the decisions. But other than revenue sharing, like we have other utilities too. Like since we are working with protocols who are going to do token launch, like in our yield versus points trading, like we are taking a commission from those points, and when the airdrop happens, Jack stakers will be eligible for those airdrops too. So this is also another way to support the stakers.
Okay, this is basically a little alpha that you are dropping here and
Yeah.
there. So essentially, if you get the Jack, you stake your Jack, you get a yield, but the treasury will also distribute potentially airdrop, in particular for I guess the PT token that you are selling at this point. Correct?
Yeah, that's right.
Okay, that's very, very interesting. And what are your objective? What is your North Star in the next, let's say, 6 to 12 months, and maybe also 24 months to have a little bit
Yeah.
more a longer time frame?
Yeah, like actually I can separate it into two, DeFi and traditional finance. In
Yes.
DeFi, like we want to become a powerhouse, like we want to become a central piece of the ecosystem. Like for example, for every chain that is launching, they are looking for Pendle, they are looking for Aave, or like they are looking for Uniswap. We want to be one of those protocols. And for traditional finance, we want to become the main distribution channel of DeFi to TradFi or TradFi to DeFi. So we want to become a bridge between those two worlds so that like Web2 participants can enjoy DeFi via StableJack, or DeFi users can enjoy the benefits of tokenized RWA assets via StableJack. So this is the like goal of us in the next 6 months, 1 year, 2 year, whatever you call it.
Okay. Okay. Very interesting. And when you look into the real world assets realm, right, that is probably crazy things that will go on chain. I think the last projection I was reading from Boston Consulting is like 17 trillion of assets will be tokenized and be on chain. I personally believe that 95% of all the financial assets in the world would be on chain. What type of real world assets, StableJack will focus on? Are we discussing about the classical bonds or also other type of real world assets?
Like emerging market assets like Turkish Euro bonds or money market funds are more interesting for us because they can provide more speculation and upside potential. So we will mostly focus on bonds, money market funds from emerging markets, maybe in the future stocks. So I can say specifically emerging market assets are going to be a focus for us.
I see. Okay, very interesting. What else do you see? In apart from StableJack, but in general, more in general, in DeFi and maybe LSTFi.
Yeah.
In general, what do you see in the near future?
I think like the ecosystem is getting mature every day. 3 years ago, like everyone can just launch a protocol and raise a couple of million and then rock and leave. So this was super easy because like the how can I say the ecosystem was not that mature and everyone just can go and play the game. But right now things are getting more difficult. I think the number of protocols that are going to be launched decrease significantly every year, and I also think that most of the VCs will left the game because they will lose so much. They don't want to come back, and also they won't be able to come back. And like the major players like Aave, Pendle, Uniswap, Etina will becoming much more bigger and bigger, and we will see less protocols they coming every day. I am not sure whether it is something good or bad, but I can say that it will decrease the excitement, maybe possibly. So even though I am not particularly happy with the results, this is what I see in the next couple of years.
I see more, let's say,
More
concentration
concentration of the major protocols, like let's
or
say.
area of influence. I see. Well, has happened in several other areas, right? So, like for example, cloud providing,
Yeah.
right? Or browser, right? Distribution. I still remember when everyone was using Firefox, and then all of a sudden Chrome have done.
That's right.
Okay, cool. All right, so going a little bit toward the end of this discussion, what do you want to tell to our communities? So about StableJack.
Yeah, I think like specifically HyperNest community is a very DeFi native one. So what I can ask them to just give StableJack a try, maybe share their feedback or suggestion so that we can also improve the product. That would be my, let's say, ask. Other than that, if you just hop on our Discord community, like happy to chat and answer any questions. Other than that, like thank you so much for everyone for listening us and spending their time with us. Other than that, I think everything's fine.
Amazing. Well, Cesar, it has been a great pleasure talking to you today. Congratulations again for the ideation and of course the execution, even more important, of StableJack. And if people want to connect with you or with StableJack, how can they do it?
Like they can follow us on Twitter or like join our community on Discord. Like we are super active in both channels, so like it is pretty easy to reach out to us.
Well, then, fantastic, Cesar. Thanks again for your participation. Really excited for the future of StableJack. And to everyone listening to us, well, remain tuned because we're going to have many other episodes still discussing about DeFi, mechanism design, and everything exciting in this beautiful on-chain world.